Hello, dividend growth stock investors. Colby the DGI Crab here, wishing you a happy Sunday morning here on November the 30th. Final day of November. This month has actually just flown right by for me. I've been working a wild amount of hours in the busy season at the new career. And as I've been saying, that is going to slow down as we get a little bit into December, fortunately. And I'll have a lot more time to do a big time backlog of videos, different viewer requests, a few emails from viewers that I need to do video responses for, and quite a few things just as far as analyzing the overall DGI Crab portfolio, ETF videos. My gosh, there's a lot to be done here. But what I want to make sure I do through good times and bad, busy times and slow, is the Sunday weekly video where I discuss the values within the DGI Crab portfolio. This channel is unique in that I focus on a list of 60 high quality dividend growth stocks that I believe are the bluest of the blue chips out there on the market, and I have subcategorized those into 4 separate categories or tiers based on the age and time horizon of the investor, which I believe is the most important metric to take into consideration. Do you want high yield, slow growth, or low yield, aggressive growth? Your age and time horizon should give you the answer to that question. Paralysis by analysis is a great way to lose money. And what I mean by that is if you are waiting to invest because you think that there is a major stock market downturn coming, or you're waiting to pull the trigger investing in a particular company because you're a little bit concerned about something that you've been reading, I'm not saying that you should just blindly go into the stock market investing without doing any sort of research whatsoever, but a lot of the times people can make things too complicated. This investing game does not have to be rocket science. It should be quite easy for you, and that is why I employ my particular strategy. I'm not a professional, do your own due diligence. I'm just sharing my personal strategies with you. So what I do, I put half of my money each week that I invest into age-appropriate ETFs, so I have automatic diversification. And I'm looking for stocks that are yielding 30% or more above their 4-year average yield. So what I'm essentially trying to do here is buy a crummy house in a good neighborhood or something to that effect. Basically, get a blue chip stock when it is down. Now, I have a top 10 list of stocks that are my personal favorite. They are 10 stocks within the overall group of 60. I'll purchase those sometimes even if the value isn't great, because I just think that these 10 particular stocks are so solid, aren't going anywhere in the long term, and will continue to increase my passive dividend income moving forward. So I want to make sure I have those positions really strong by the time I have hit financial freedom. And I remain within my age tier unless there's a stock in a different tier yielding 50% or more above the 4-year average yield. We've got 4 stocks in the group of 60 that are in fact doing just that. And if there's not a buyable stock within my category, I don't invest less. I will just put more money into those ETFs for that particular week. And as we jump into the strategy spreadsheet here, you guys, I'm going to start with my top 10 favorite dividend growth stocks. These are the ones that I mentioned that I will purchase sometimes whether they look particularly cheap or not. I sort everything here by the valuation tab. This is very similar to what you will see on a site like Simply Safe Dividends, where I'm comparing the 4-year average dividend yield to the current day yield to determine how far off that stock just happens to be. Visa did a dividend increase fairly recently. They're yielding 0.8%, and they typically yield just 0.71% over the past 4 years, meaning that's about 12.8% higher than what you can typically expect to get when you buy shares of Visa. The same applies to all of these here. That's how I have them sorted, and I'm primarily trying to get stocks that are in that 30% or higher mark, and right now, none of my top 10 stocks have fallen into that category. But really anything from Visa, Procter & Gamble, and Pepsi, I would consider strong purchases, especially for long-term investors at these particular prices, because these stocks don't typically trade very cheap for long periods of time. Pepsi has been in a bit of a slump for a little while right now, but I have been adding to it each and every week for quite a while now. Now let's do this age-wise, you guys. Tier 1, 18 to 30-year-old investors. This is Tier 1. This is the group of investors that probably shouldn't be too concerned with starting yield. You're not trying to get really high starting yield if you are 30 years old or younger. You need to be looking for that aggressive dividend growth. We want that number to be well north of 10% year over year, so that way you can get a real dividend snowball going over the long haul. And if you are 30 or younger, the long haul is exactly what you should be able to look forward to. United Health, Nike, and automatic data processing, all within that buy zone. Nike and United Health continue to just get completely beaten up. Who knows when they're going to demonstrate a full recovery, but for right now, they still both look cheap enough to me that I would continue to buy, especially if I'm in that younger age category. All three of these bargain basement stocks right now are going to yield you not only above 2%, but above 2.5%. Very nice starting yield for you younger investors out there who typically would be spending your time and should be spending a lot of your time buying things like Visa with yields in the 1% or less range. Another one you might want to keep your eye out on right now is Cintas. Cintas hasn't been undervalued for a very long time now. I think you might have to go back to the COVID crash since Cintas was undervalued, and at that point for a few months just about everything was. And not quite at the point where I'm jumping all in on it just yet, but keep a very close eye on it. Centos stock has been dropping a bit in recent weeks, and if it gets too much lower, could be worth paying attention to. Tier 2, age 31 to 41-year-old investors. 19 of the 60 stocks are in this category. It is the largest individual category here. We're usually looking for 2.5 to 3.5% starting yield in this category with a high single-digit dividend growth rate. Target goes well north of those projections, still yielding above 5%. Still a strong purchase choice for just about any age category. I know that we're not going to get great dividend growth out of Target. Well, I shouldn't say I know. It's very likely we're not going to get great dividend growth out of Target in the short term. But when your starting yield is this high, you can afford to get paid to wait at that point for the growth to come back. 5% starting yield. I do not believe that this is a dividend that's in any danger of getting cut. It's just the yield might be growing a little bit slower, but I will happily take that 5% starting yield on Target. And McCormick and American States Water, the next two down, also in the buy zone, yielding in the high 2%. Super steady companies that grow that dividend in the high single digits like clockwork, it seems, year over year. Just what we want in this tier 2 category. McCormick and American States Water are the epitome of what I want in this category. Tier 3, age 42 to 53-year-old investors, are starting yields getting a little bit higher in this category, starting to look more in the 3.5 to 4.5% starting yield range. And we want a mid-single-digit dividend growth rate. 4 to 6% at this point is fine. The 6-7% is great. If it's 4 or 5 in a given year, like last year, not the end of the world, because we are typically getting stocks in this category when they're in the buy zone in the 4% range for a lot of them. You see here with Hormel, who just very recently did a very small dividend increase. I'll be doing a video on the November dividend increases, and I will be happy to report Hormel is a part of that. Similar to Target, I don't think we're going to see big dividend increases out of Hormel in the short term, but both are dividend kings with 50 plus years of consecutively increasing the dividend. I don't think either of those companies are going to stop doing that anytime soon, and I will happily take the 5+% starting yield on Hormel as well. Pepsi, of course, being a top 10 favorite of mine, is in my personal buy zone. American Tower, pretty close to being in that buy zone. I still, especially for real estate investment trust, want to make sure I'm getting a real bargain on that because the dividends aren't qualified. I put my real estate investments into my Roth IRA exclusively right now, but I'm at the point where American Tower could be one that I would start to consider adding in my brokerage as well. And Procter and Gamble, I've been nibbling at Procter and Gamble now for a little while, and again, not a massive value here at 16.5% undervalued, but it is in my top 10 favorite stocks, and I don't think it gets super cheap all that often. Tier 4, age 54 and older. This is the category where we do want to start adding current income to our portfolio in most cases, especially if you are still working your way toward financial freedom with your dividends and you hit age 54. You can yield chase a little bit here. And I don't mean by really high yield trash that's ultimately not going to be sustainable. I still want to get dividend growth in this category. We're talking 5 to 7% on average in the stocks. You want about a 2 to 4% dividend growth rate out of this category. And again, not anything super appealing here. The high yield category has just been very stable and consistent for the past year plus. I haven't seen a lot of stuff that's super undervalued. Not a lot of this stuff is very overvalued either, but there are so many excellent high yield options in the ETF categories that if I'm 54 and older, I will just put more and more money into my ETFs as opposed to some of these individual options. I love these stocks. I love stocks like Realty Income and that steady monthly income coming in month over month and growing a little bit year over year. But I definitely want to get that at a discount because these single stocks are inherently more risky than ETFs. So let's talk about the priorities for the tiers here. If you are in tier 1, like I said, I put half of my money each week into age-appropriate ETFs, and if I'm in tier 1, I prioritize the S&P 500, build up that S&P 500 exposure when you're young. You will be glad you did when you are older. I also want to get some VBR, small cap value going, and start getting a little bit of a position in VIG for the dividend growth factor here. And VYMI remains my only non-US investment. I love this ETF from Vanguard. And then as I'm going through, I'm prioritizing the stocks that are in my top 10. So Pepsi and Visa to me are both good to go in this young age category. And then the stocks that were in the buy zone in my tier were United Health, Nike, and Automatic Data Processing, Target and Hormel, the tiers 2 and 3 stocks that are yielding more than 50% above the 4-year average yield. Nordson and Centos will remain on the watch list for me in this category, but they're not quite in that buy category just yet. For tier 2, same 4 ETFs, different weighting on those. VIG is the primary target in this particular category. I really want to start building up compounding dividend growth in my 30s. I don't want to completely stop investing in the S&P 500 or my small cap values. And then I'm going to look at my top 10 favorites. Not really anything in the tier 2 category that are in my top 10 favorite stocks like McDonald's, like Union Pacific. Not quite at that point where I want to start buying those over things like Pepsi or the stocks that are in my own tier that are showing good value. Target, McCormick, AWR. United Health and Nike and Hormel all could be stocks outside of this tier that I focus on. And I'm going to keep a close eye on Hershey and McDonald's at current levels, but I'm not going to be pulling the trigger just yet. For tier 3, I've got a combination of yield-based ETFs that I really like. SCHD for yield and growth, VYM for yield plus diversification, and DHS for monthly yield. Pepsi and Procter and Gamble are good to go ads for me, as well as Hormel within my own tier. And I'm probably going to continue to add to my positions in United Health, Nike, and Target because there's just not a lot in my own tier that's in that buy zone. And then finally for tier 4, I'm going with a lot of ETFs primarily. MLPX, SPHY for the high yield bonds. I've got preferred shares. I've got real estate. All of these ETFs here, I think, are fine options for the income seeking tier 4 individual. And if you are not trying to get the really high yield stuff, you've still got some room in your portfolio for growth. Pepsi yielding just below 4% is not bad right here. And you get 5% or better starting yield on Hormel and Target. pretty appealing even for the tier 4 investor, certainly more so than the stuff in their own category's been lately. So that's the video for the week, you guys. Email me your questions at dgicrab@yahoo.com, and I will catch you on the next one.